Investment Basics for Actors. Hey everyone, I'm Matthew Cornwell with Get Taped here in Atlanta, Georgia, one of Atlanta's original audition taping services, which I co-own with my amazingly talented, beautiful wife and best friend, Brooke, who I'm away from right now because I'm at my mom's house in Florida. And now on to our topic. Investment Basics for Actors. Okay, so this is a very dangerous topic for me to get into because investing is very complex and nuanced. So I'm going to just give an overview of it, especially if you're an actor and you've never even thought about the stock market or investing. And then I want to relate it to our acting careers as sort of a metaphor. And at the very end of the video, I'm going to give you a concrete example of how you might consider investing your money long term, especially when you think about retirement age. And before I get into any of that, let me first put out a disclaimer that I am not a financial advisor. I'm not certified. I don't have an MBA or any sort of degree in investing or finance. So take anything you hear from me with a grain of salt, and please consult your own financial advisor before investing any money. And let it be known that any investment comes with the risk of loss of your money, or your principal, as it's called. Okay, so let's talk about the stock market. But not too much, because this is such a complex and hard to understand thing. Even understanding what a stock is not trivial. And the best way to think about it for the purposes of our video is to think about going to a convention for collectibles, comic books, baseball cards, coins, stamps, whatever. And think of those collectibles as stocks. The value of those items is sort of mysterious, right? There's an intrinsic value, maybe, but really the price that you're going to get for that collectible or that stock seems to be based on what we call market forces, supply and demand, perceived value versus intrinsic value, etc. So I invite you to do research on your own to further understand what the stock market actually is, how it works, how the price of a stock is actually determined. But again, that's beyond the purview of this video. And I will link some resources in the show notes below on how I did learn what I do know about the stock market. Hint, most of it was from Jim Cramer on CNBC. So without getting lost in the weeds, I want to talk about two different types of investors, and I am grossly oversimplifying how investors approach the stock market. But you could categorize the majority of investors into two different groups. One being short-term investors, sometimes called day traders. The other would be the long-term investors. That would be me. A short-term investor buys a stock in the morning and is watching the stock market all day long because they might want to sell it before the end of the day. And they'll do that again tomorrow and the next day and the next day. The long-term investor, on the other hand, buys a stock today and largely doesn't pay attention to the stock market, at least not minute to minute or hour to hour like that day trader. That long-term investor has a long-term horizon for that investment and is more concerned about the stock price in a month or a year or in 20 years. And so which one of those is more lucrative? Who is making more money? It's not that simple. And let me give you two examples. All right, so let's say, for example, you bought one share of Spacely Sprockets for $100 on January 1st. Now, the long-term investor, let's say that in a year, January 1st of the next year, they sell that stock because now it's at $110 and they're happy with that gain. They've made $10. On the other hand, the short-term investor is watching that stock every single day as it goes up and down. And so let's say over the course of that same year, they were able to sell it at $110 and then wait for it to go back down to 100 and then buy it. And then it went back up to 110. They sold it. It went back down to 100, so forth and so on. And let's just say over the course of that same year, that happened 6 times. That means the short-term investor just made $60 in a year. And the long-term investor with the same share of stock only made $10. So does that mean that short-term investing is the better way to go? Well, let me give you a different example. Let's say Spacely Sprockets was $100 on January 1st. The long-term investor buys it, and it steadily goes up throughout the course of the year to $200. So January 1st of the next year, they now sell it for 100% profit. They made $100. Meanwhile, that short-term investor at 110, they sold it expecting it to go back down to 100, and it didn't. And so they waited as the stock went up to 120, and they still think it's coming back down. And then maybe it did come back down a little, but not very far. And then it goes back up, and now it's at 130, and now it's at 140. And at 150, they finally pull the trigger and jump back in. And then they ride it the rest of the way up to 200. So they made $10 initially, but then they jumped out, and then they made $50 more for the rest of the year. So they made $60 again, but that long-term investor made $100. So what's the conclusion? Should you be a short-term investor or a long-term investor? Well, we have just scratched the surface of the complexity of investing. But one thing I can say, as we now switch gears and talk about acting, is that that long-term investor didn't have to put much effort into that transaction. They bought the stock on January 1st and just sort of casually kept an eye on the stock market, but not overly concerning themselves with that minute-to-minute, hour-to-hour, day-to-day fluctuation, and casually sold it a year later for a profit. That day trader, that short-term investor, was scrutinizing and stressing about that stock market every minute of every day for an entire year, multiplied by every year that they decide to be an investor. So you might be able to see where I'm going with this as an actor. If you approach your career like that day trader, you're going to be so stressed out. If you're concerning yourself every minute of every day with each audition and what the outcome is, and whether or not your agent is doing everything they can for you, and whether or not this casting director hates you or not, or whether or not the headshots you have should be updated, you're going to overly stress yourself out, and you might burn out prematurely and leave this industry right before you were about to break through. Whereas if you approach your acting career like that long-term investor, you will save yourself a lot of grief if you don't stress every minute of every day about the minutia of things you can't even control. Market forces are causing the prices of those stocks. I mean, the vicissitudes of your career. So why overly concern yourself with things you cannot even begin to control? Doesn't the long-term investor sound a lot more attractive, sound a lot more peaceful? Sure does to me. And I should say that this metaphor I'm making for the long-term investor doesn't mean that you're complacent or that you're lazy. No. You're still doing the things you need to do. Just like when I was investing a lot in my early years, in the late 2000s, I was still reading a lot of books. I have a ton of them on my shelves at home. These aren't those books. These are my late father's collection of science books. So to be clear, as that long-term investor, as that long-term actor, you should still be training. You should still be concerned about your materials. You should still be concerned about the market and how things are going. So that means you're keeping on top of the topics like the strikes that were happening last year and the possible IATSE strike this year and other market forces that might have an effect on your career. But you're just not overly concerning yourself with every tiny detail of this industry and how it's affecting you minute to minute, hour to hour. That's not worth your time. It's not worth the stress that comes with it because it's something you can't change or even affect. Okay, so that was my quick metaphor on long-term investing, short-term investing, and how that might relate to your acting career. I do want to end this video, as promised, with a concrete example of how you might actually use your money in the stock market to make money. So back in 2007, I took the advice of Jim Cramer and many other financial gurus that I was reading, which was to say that if you don't have time to commit to researching individual stocks, the way Jim Cramer used to say it, I think he still does, if you're not willing to commit 1 hour of research a week per stock that you own, that's per week, then you should not invest in individual stocks. So for example, if you diversify like you should and you have 5 or even 10 stocks, that would be 5 hours to 10 hours a week that you would need to devote just to researching your stocks and how they're doing, the business that is underneath that stock price. I don't know about you, but I don't have that kind of time. So instead, I did what Warren Buffett, Jim Cramer, and so many other financial people say, which is to invest your money in an index fund. And without going into the nitty-gritty details, essentially you're just buying a tiny piece of a bunch of stocks, which is a way of diversifying even more with none of the research. And so starting in 2007 and every year since then, I put money into an IRA. and invested that money in an S&P index fund. Now, you can choose a mutual fund, you can choose an ETF. That is getting lost in the weeds again. But if you were to open a brokerage account or an IRA like I did, which has tax advantages, and you fully fund that IRA each year, check the internet for the latest cap on how much you can put into that IRA each year. And then you just let that money sit there and grow. Yes, some years during a bear market, during a recession, or even a depression, that money will dwindle. It'll go down. But over any 20-year period since the stock market has been in existence, you will make money on an S&P index fund. And the amount of money will be better than that savings account you get with your bank or with your credit union. And so without revealing my actual finances, the money I started with back in 2007, contributing to it every year since then, well, let's just say that the total that I would have had if I just put into a savings account, I have more than double that in just 15 years by putting that into an IRA, specifically into an S&P index fund, and just letting it grow and not scrutinizing that balance every single day, every single hour, every single minute. Now, I'll end this how I started it, which is basically saying that I am not a financial advisor, so take anything I said with a grain of salt and do your own investment research before you start to actually put your money to work. That said, if you have any questions, drop a comment below. I'll be happy to give you any wisdom that I have or try to point you in the direction of someone who might have it if I don't. That's it for now. Thanks for watching, and we'll see you on set.